Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, it's Agostino. Navigating and understanding market cycles is important to avoiding bubbles and making great investments. If you haven't been through a market correction, there are plenty of lessons to be learned from previous bubbles. Regardless, many real estate investors still get sucked in each time and they come out losing their shirts, while others take advantage of the cycles to profit. Well, today's guest has built a multi-million-dollar real estate portfolio and has made his selections with a combination of picking the right markets and strong underwriting. He began his career as a lawyer and spent well over a decade practicing in top law firms where he focused on real estate and hospitality. Now, he helps investors diversify their investment portfolios, obtain income, and achieve capital growth through investments in multifamily real estate. Additionally, he helps others succeed in multifamily through a very active real estate mentoring Facebook group while helping other syndicators build their portfolios and achieve financial freedom. Now, with all that, I'd like to welcome Jonathan Twombly to the show. Hey, Jonathan, thanks for coming on. I appreciate it.
Hey, thanks for having me on the show. I'm really looking forward to this.
Yes, it's going to be great fun. Before we go on, if you like what Jonathan has to say, check out his company website at realestatelaunchpad.net, where he has a great podcast there as well. Definitely check it out. You can also email him at jonathan@multifamilylaunchpad.com. Okay, Jonathan, maybe go ahead and tell listeners about how you got your start.
Gosh, it's been a while. I've been in the business since 2011. So I came into it after watching really closely on the sidelines kind of through the crash, got into it fairly early after the crash. As you mentioned, I'd been a lawyer on Wall Street for more than a decade and wasn't particularly happy with that and was looking for a way to get out, try to transition into some other field. I was very intrigued by investing in different forms, whether it was equities or real estate. And there's a lot of things that sort of came together at the same time for me. I had been trying to get out. I'd been talking to people about real estate. I'd been trying to figure out what to do. The crash happened. Then I was sort of just felt lucky to still have a job. Then eventually that caught up with me. I was doing litigation at this law firm. And, in my experience with litigation was that I went through the dotcom crash. And after that happened, there was just this massive wave of litigation. Like everybody was looking for somebody to blame. And there was too much work for lawyers even. And when the financial crisis happened, we all sort of girded ourselves for this big wave of litigation, which then never happened because it was so bad that people didn't even want to spend money on lawyers to find somebody else to blame. So we wound up instead kind of like sitting on my hands for a couple of years. And my firm actually kept me on for 2 years longer than I would have if I were them. But they didn't want to let good employees go, I guess, because they were still waiting for this wave of litigation to come. Finally, they got tired of paying me this crazy salary to do nothing and let me go. I had kind of seen the writing on the wall and was starting to network with people who were in real estate to try to figure out if I could transition into that. And I kept on running into was people saying to me, hey, Jonathan, you have a great background, but at your age, it's going to be really difficult for someone to hire you because chances are like you're going to have to work for somebody who's younger than you, who's like got no kids, and they're not going to be able to tell you to stay late. So they're just not going to want to hire you at all. Things like that. And plus there are 10,000 guys on the street right now who have been in this field for 10 years and are not career changers. And, if anybody's going to get one of the jobs, it's going to be them. So the only way you're going to break into this is if you just happen to find somebody who wants to be your partner. And to make a very long story short, that's actually what happened. I just, through talking to a lot of people, I ran into a woman who was starting up a syndication business, even though I had no idea what that was at the time. She said, look, I think that you have the ability to raise money. Why don't we join forces and do this together? And I started talking to some friends of mine, more or less because I wanted to vet her and see what they thought of her. And what wound up happening there, I was expecting them to say, this is a bad idea, don't do it. Instead, what happened was they said, oh, I like what she has to say. She's making a lot of sense. She seems like she really understands this. If you decide to partner up with her, I'll give you money to invest. So I sort of thought all these things are coming together at once. I just lost this job. I've got some money saved up. I can do a new thing. I don't want to be a lawyer anymore. I've got this offer to join this partnership, and I've got people who want to give me money. I should just do this and see what happens. And I remember very distinctly, like the very first day that we sat down like to do business. Once we had agreed to join up as partners, I thought we were going to go buy like brownstones in Brooklyn because that was where my head was at. And instead she said, oh no, we're going to go buy 100-unit apartment buildings in Louisiana. And so that was sort of mind blowing. I was just like, how can we even do that? Like, how does one do that? And that was my introduction to the field back in 2011.
Wow. That's awesome. So you ended up going through with it. You ended up taking down a deal. So you were responsible for the syndication part of it, I imagine, right?
What ended up happening was that our division of labor she was doing the underwriting and doing, the deal sourcing. And I was supposed to be doing the money raising part of it, which I later learned was syndication. Even though, I'm a lawyer, I wasn't a real estate lawyer, I wasn't a partnership lawyer, but I had read a lot of these documents on the back end during litigations, like when these partnerships were falling apart and I was litigating them. So once we got into it, I was like, oh, I know this. I've seen this before. I understand what was going on. So I kind of had absorbed a lot of the understanding of these structures from unpacking them as a litigator before. So yeah, we got into contract on a couple of deals, and then we just had things sort of go sideways. Like ironically, we were in a situation where we had all of the equity lined up because these friends of mine had said like, hey, Jonathan, I've been wanting to do business with you for 10 years. Like, here's money to invest. So we had all this money set to go. And we wound up actually getting dinged by the lender on these cases that we went into contract in Louisiana, where the lender went down at the very, very end of the process. As you probably know, the very last thing they do is they send some junior underwriter down there to basically make sure that like the building is still there and that it's as represented. And we actually got dinged at that stage with a bunch of stuff, which was just kind of led us to believe that the lender was looking for a way to get out because for whatever reason they had decided that they didn't like the market or they didn't like the asset. We really never could tell. They said it was for some physical stuff, but it was before their engineering report ever came back. And they basically told us like, even if the engineering report comes back fine, we're not doing the deal, which didn't make any sense because the stuff that they were talking about was super minor stuff. I mean, they were literally talking about like dirty breezeways, just like one of the things they put on there.
Wow.
Like they take care of with a power wash, or they said like there are 10 down units. We're like, yeah, well, that's why we're buying this property. This is a value add deal. Like we're getting, 100 units for the price of 90 because 10 of them are down. This is awesome. And they were like, no.
Yeah.
So we wound up getting knocked out of one deal. We were in contract in a second deal with the same seller, and we got skittish. I think probably having had that recent knockdown from the bank, we got skittish on something we found in due diligence, which now I would not be worried about. It was just some issue with like the boiler setup, but made us very anxious. We pulled out of it. And then ultimately we decided that like, hey, maybe we should go our separate ways as partners. So we wrapped it up at the end of 2012. We were in business together for a year and a half, got into contract on 2 deals, spent a lot of money on due diligence, spent a lot of money on lenders' fees, spent a lot of money on lawyers, and had nothing to show for it at the end. It was a pretty devastating experience.
It's very expensive education.
Yeah. I mean, actually, it turns out it probably would not have been as expensive as me going to like a real estate program at NYU, which was what I was thinking of doing, but it was still expensive nonetheless.
Yes. So between then and now, though, you've done many other deals with other partners, I imagine, and by yourself too, right?
Well, so what happened then was one of my friends who was going to invest in deals with us, and I sat down after this first partnership kind of busted up. And we went and had dinner, and I said, gosh, I don't know what I want to do. I think I may have to go back to practicing law. And he said, don't be hasty. He said, why don't I back you in a business? And I'll invest in the GP and in the deals, and you can go raise money from other people, but I'll give you like some cushion so that you can continue to move forward on this. So we went forward in that. And one of the smart things I did in the first go round was that I never spent any of my investors' money, right? It was only my own money that I spent. So my investors didn't get hurt in any way. They just didn't get to spend the money that they had planned on spending. So they had, first of all, they had it all set aside still to invest in deals, and were happy to go forward when I had deals to do. And they had no sort of bad taste in their mouth, even though we had gone through some pain. It didn't affect them at all. So I was still in a good situation starting out the second business. And then, really the first business was my education. And the second business was where I got to apply that education and get to kind of activate some of the networks I had built and, use what I had learned the first time around to do things, I guess, better or what have you the second time.
One of the things that I imagine you learned throughout all this process is, of course, you're doing the underwriting, you're being very diligent about that, but you've been through some of these bubbles, you've been through numerous cycles. And I think today, I know that you are somewhat skittish about buying and taking down new deals, right? I mean, and I know that you said like we've been on a bull run for a very long time. So maybe you could talk to that a little bit. What indicators do you see that we're going to be slowing down or even retreating? Like, what do you see in that regard?
There's a lot going on right now that makes me anxious. And it really started happening about 2016 or so, where when I first got into the business, the challenge was finding deals that worked because the pricing was really sticky. The sellers were still expecting their 28 pricing or 2007 pricing, even though their assets were not worth that much, right? So it took a long time for the sellers to get realistic. Once they did, then the issue became like bringing the banks along, right? Then we kind of hit a little sweet spot right when I formed this business where it was starting to get easy to transact. Like sellers weren't crazy yet. They were happy to be able to start selling properties. I think some of the smarter ones were kind of looking forward and saying, hey, we're at the beginning of a new cycle. Let's sell some older properties, free up some cash so we can go spend money now at a good time. And I'd say sort of 2013, 14, 15 were pretty good years for being able to buy assets at good prices. Like, I wasn't stealing anything from anybody, but still, there was a lot of meat left on the bone on the deals. About 2016, I started seeing prices just getting really out of control, where suddenly I'm getting approached by brokers with off-market deals. And we had started to have to stretch a little bit in 2015 on stuff, making offers on deals where it's getting a little bit uncomfortable, but we still felt it was within like a tolerable range. 2016, the experience started to become, we get a broker would bring me an off-market deal. I would underwrite it. We'd have this conversation. They would say, the pricing is changing. It's becoming a lot more of a buyer's market now, a seller's market now. You're going to have to stretch on this. And I would stretch to the point where, I'd submit an LOI and my first thought would be, oh my God, I hope they don't accept it. And then the answer would come back, oh, you're 20% below what they're looking for in this deal, right? So I was at the point where I was stretching myself beyond my comfort level and hearing that it wasn't even close and other people were paying it. And I realized at that point that the market was just getting a little bit, too frothy for someone who's as conservative as me. So, with that background, what I've been sort of watching happening is it seems to me that around 2016, there was a big flood of new syndicators coming into the market. And I think that's the product of, it's a product of a number of different things. One is in every cycle, you see this pattern where people sit on the sidelines for a very long time because they're still like dealing with shock from the last crash. And then there's some people who are just new. They're just too young they didn't go through it. But as the market climbs higher and higher and higher and people start to exit and make profits, other people see that. The people sitting on the sidelines see those investors making money, and it creates a lot of desire on their part, and they start jumping in. So a lot of people started jumping into the market. That happens in every cycle. But in this cycle, I think what made it even worse was this was the first cycle where you had podcasting was a big thing. Bigger Pockets was a big thing. Like there's always been real estate coaching, but it just, the business exploded. So all of a sudden you had all of these people who were now educated in the process of syndication who had never even heard of syndication before. Syndication was a really minor thing back before this cycle. Obviously it existed, it's always existed, but it was not on everybody's lips the way it is now. And so I think that you had the typical flood of new people coming in at the top of the market, but also there was this huge sort of supply side thing that also happened with just people being able to find out about it much more easily than they had before. And that created a lot of new demand. I think it just pushed prices up further and further and further. So that's part of it on the pricing side. There's also, this market has been going on for a very, very long time. It's one of the longest bull runs in history. And I know, they say markets don't die of old age, but that's not entirely true. And the reason it's not entirely true is because after a while, the good assets have been purchased, or from a lender's perspective, they're lending on sort of more and more marginal deals and to more and more marginal players. And you're also getting deals that now they're being sold the second or third time in this cycle, right? So same asset is now 50% higher in price or 100% higher in price than it was without any real change in the fundamentals. Maybe rents have grown some or whatever, but the deals really sort of make less and less sense, and they start to stretch more and more and more. Last time around, when it started getting to the point where prices were so high that people couldn't make much of a return on equity at your normal leverage levels, they started increasing the leverage, right? So they started having all this mezzanine debt added to deals. So if people don't know what that means, like you have your permanent debt, like your bank debt, which would be, say, 75% of the capital stack. But then you could go out to another lender and get a second slice of debt that was subordinate to the first, to be wiped out completely if the first lender foreclosed, and get yourself up to like 90 or 90, even 93 or 94% leverage so that your equity piece was really tiny. And even though you were paying a ton of money for this deal, in theory, you'd make a good return on equity because you were so heavily leveraged. The problem was, as soon as the economy went bad and your vacancy started to rise, people couldn't make their debt service.
That's right. You're hosed right after that. You're done. Yeah.
Yeah, they're totally hosed. Yeah, that's where the foreclosures came from. So what's happened this time around is now, the lenders said, okay, we're not going to do that anymore. Your loan documents prevent you from adding any extra debt to these deals. But now what the lenders are doing is giving people a lot of interest-only debt, right? Which is just the same thing. It's a hidden way of increasing the leverage on the property. And everyone's hoping that after 2 or 3 years, that we'll have so much rent growth that when you have to go and start paying a full mortgage payment, you'll be fine. This is exactly what happened in like single family houses at the last bubble with these interest, these teaser mortgages that people got, 2 years of interest only, and then it reset because everyone's going to sell their house in 2 years and flip it and make money. So you weren't supposed to ever pay that. I think you're going to see the same thing happening in multifamily. I'm still not really answering the question as to why I think that things are changing. Just to bring it back, what I'm seeing, in addition to really crazy high pricing, is that you've got massive amounts of new supply coming online, right? There's going to be, supposedly this year, there's going to be like a record number of apartments built this year because everybody's jumping on the multifamily bandwagon. That's the typical thing that tends to flip the market over into the hyper supply phase. But on top of that, the warning clouds are there on the horizon about the economy too. So I think you've got like two things happening at once where we're going to get into an oversupply situation very soon. And the cracks are showing with the economy, where even though unemployment is very, very low right now, there seem to be some signs it's starting to trend back upwards, which always happens at this point in the cycle. And I think we're really at kind of like that knife's edge point in the cycle where something is going to cause it to pop, but we don't really know what. It could be anything.
Right.
And that's not to say it's going to happen tomorrow. Like, I don't have a crystal ball, so I can't say it's going to happen this year, it's going to happen next year. But I'm just at the point with my own investing where I feel like if you know the bubble is going to pop, then why would you get in? Like, why would you be in it right now? And as a matter of fact, as you know, maybe the audience doesn't, but I just recently sold all of our holdings for this. This is one of the reasons why I did, because where we are in the market, we could talk more about sort of C properties and stuff too, if you want to. But just in terms of where we are in the market, I felt like the pricing was never going to be higher than it is right now, or even if it's a little higher, it'll be not materially higher. It's a great time to sell these properties to somebody else and make a good return for my investors. And I didn't feel like I'd be able to do better by waiting longer. So I felt like I owed it to them to sell now and give them really strong returns now, rather than miss the opportunity and try to be selling after the thing collapses, which, as you know, is like impossible. So
yeah. I mean, it's funny because I see the same sort of cap rate compression you just described here in Cleveland. where it's getting to a point where it doesn't make any sense at all. The cost per door is so much higher than the income that's getting brought in. It doesn't make any sense. You're talking properties that used to sell at a 10 cap for typical C-class property in any location. That's a cash flow type of area. 8 to 10%. That's typically what we're doing right now is in terms of the asset class that we're specializing in. Now we're getting down to like the 6s and the 7s for a C class, which doesn't make any sense in this market. Now, are you seeing the same sort of thing? Or is this driven in markets across the board? Or are you seeing that this kind of thing is really isolated to certain markets and there's still some opportunities out there?
There may be markets out there where there's some opportunity that I'm not aware of. But in general, what's happened in this cycle too, which I didn't mention, which is different from the previous cycle, is that we've also had 10 years of every central bank in the entire world printing money like it's going out of style. And that is one of the big drivers of asset prices in general, whether it's real estate or stocks, pretty much anything. Bitcoin, I think Bitcoin is worth anything just because there are a lot of people who just don't know what else to put their money into it. So they think, well, maybe this will work. And in a normal environment, it wouldn't have gotten anywhere. But it's just because of all the liquidity that's out there. And so what's happened is I watched this process because being in New York and investing in South Carolina put me in a little bit of an interesting position because I was talking to a lot of investors in New York really early on in the cycle. And I've seen what's happened over the course of the cycle. So back in 2012, 2013, when I was out trying to raise money for deals in South Carolina, in New York, the typical response I got was, why? Like, why would you do something so risky as to invest in South Carolina? And I would say, and I'd have to go through and say, look, the demographics of South Carolina are phenomenal, right? Like this state is growing so fast. It's not like the anemic growth we have here in New York. It's growing really, really fast. The supply can't keep up. Jobs are moving to this state. They're bringing in manufacturing. This is a really good story. And people in New York would say, it's too risky, it's too risky. But as all of the flight capital from China and Russia and other places like that started flooding into New York, started driving down the cap rates in New York City. I mean, they're always low because it's seen as a relatively risk-free market, but you used to see assets like multifamily assets trading at 5 caps or maybe even 6 caps for C product. And that just got driven downward and downward and downward because people were bringing money from Hong Kong where the cap rate was 2, right? And thinking that a 3% cap in New York was amazing. And they're driving the cap rates down to 3%. Plus you had all these investors who literally their alternative investment scenario was having all of the money expropriated by the government, right? So for them, like negative cap rates were better than having it all taken from them. So they're buying buildings in New York for negative cap rates, right? And so the New York investors start saying, well, this is crazy. What are we going to do? So they start moving on to places like Charlotte and Dallas and the second tier cities. And then the same thing happens there. The process repeats itself. Then the investors from Dallas and Charlotte start going to Greenville, South Carolina, like where I was. So suddenly there are all these people who, a few years ago were telling me South Carolina is too risky. Were now telling me, like acting as if they discovered some secret, like, oh, South Carolina, you can buy B assets at a 6 cap, which for South Carolina was expensive because when I started there, you were buying B assets at a 7 or 8, and you're buying the C assets at an 8 to a 10 cap, right? Especially for suburban garden style apartments from the 70s. So you've seen these search for yield, as they call it. The money just flows to wherever the yield is, and it tends to drive it down. So if you'd asked me this question in 2011, I would have said, oh yeah, no, there are markets that are like still crashing. There are markets like that are recovering. They're in all different phases of the cycle. After 10 years, I'll go out on a limb and say there are no markets left that are not peaking, right? I mean, I laugh every time I hear somebody talk about an emerging I'm investing in emerging markets. I found an emerging market. Like, there's no emerging markets in this after 10 years of like this amount of capital being pumped into the system, right? There are no emerging markets. There are some markets where cap rates are higher, like Cleveland is one. We can talk about that too. the cap rates are higher in Cleveland than they are in New York City. They've always been higher in Cleveland than they were in New York City. And if you think that like you've discovered something because the cap rates are higher there, there's a bridge I can see from my office window that I'd like to sell you. So there isn't anywhere left, right? That is not, with respect to itself, overpriced, right? So things may be cheap. They may seem cheap compared to other places, but you have to look at markets in a silo on their own and decide whether they're cheap or not. And I would say there's probably very few places out there that are cheap on their own terms at this point.
I know one of the resources that you look at when you're looking at these different markets and you're coming up with your assessments is the one by the Black Creek Group, the Mueller Report. And I recently looked at it. I don't know if you have it up there on your screen, but I think Oklahoma City is it's in the quadrant of recession, I believe, right?
It's right on the borderline. I do have it up on my screen. And if you guys don't know about the Black Creek Group, they put out this report every quarter by Dr. Glenn Mueller, who's the guy who actually discovered the real estate cycle. He's an economist who discovered the real estate cycle. And so he writes a report for them every quarter. If you pay them, you get it, the most recent one. But if you don't pay, they'll give you 2 quarters ago, essentially. So 1 quarter off for free. So the most recent one that they have on their website for free is for fourth quarter 2018. Every single market that they follow is at the peak or past it. And Oklahoma City is on the borderline between hypersupply and recession. But basically you've got like all 52 markets that they follow are basically peak or past it, right? So
that's right.
And the way they determine that is it's basically a supply demand function, right? So they're looking at the number of units coming online and where they are with respect to long-term occupancy. So some of these markets are now starting to approach their long-term occupancy, which is, when they do, then they're going to enter into the recession phase.
Yes. Well, but it's funny how even everybody's making the run to Oklahoma City right now. Just about every syndicator I talk to, everybody's looking at stuff there already. So either they know about this report or they just happen to see the value. I don't know. But even from what I've been told, just what you said, they think they've discovered an emerging market, but really they're just getting product at just a cheaper or an increased price.
Yeah, I mean, maybe they are. Maybe Oklahoma City is a place to go and start looking at the situation, because maybe they could be waiting for it to bottom out and go back up. I think the mistake people might be making is if they're just looking at it purely statically to say, oh, okay, assets here look cheaper, so it must be better. It may be the case if Mueller is right about where it is in the market cycle. There's still some way to go down, right? I mean, they're just at the very beginning of the recession phase. You're not into sort of like discounted, distressed asset sale prices yet, because they're just back at long-term occupancy, which, you should be underwriting your deal so that if you're not making money at the long-term occupancy rate, like you've really overpaid for this asset, right? So they're just back there at quote unquote normal right now. And I would not consider that like a bargain yet. It's still like a relative bargain compared to maybe some other places you might be looking, but it's not a bargain with respect to itself quite yet. But if you're prepared to hold it, I mean, you just have to understand it's going to go down before it comes back up. If you think you're buying now at the low point, like if you think this is the low point, then I think you may be in trouble. If you're getting into it thinking like, okay, I'm buying because it is cheaper than other places and I know what I'm in for and it's going to go down before it comes back and I'm ready and I have a plan in place to deal with that, then that's one thing. But going in there saying like, yeah, I'm getting in on the ground, you're probably being overly optimistic about that.
Yeah. Well, let's talk about getting into deals. So I know that when we were in the green room, you had mentioned that you're not really looking at a lot of deals these days, just because of where the market is right now. But I guess if you were to look at deals, what sort of underwriting or what sort of considerations would you apply looking at a deal today, given where it's at? Like, how careful would you be?
I would be much more conservative than when I started out, given where we are now, because I think the reality of the situation is that you're paying a premium for deals at the moment. The combination of a long run up and lots of capital out there chasing deals. So you're paying a premium for deals. If you're going to go in at these very high valuations, then you really have to be thinking about your downside risks. So if I were looking more actively at deals, there's a couple of things I'd be doing. One is I would be really doing some serious scenario planning to figure out just how far away I am from like the foreclosure scenario, like where I can't meet my debt service, right? And to be really brutally honest about that, like planning for a pretty bad recession 2 or 3 years into the holding period, right? Now, whether that happens or not, that's kind of irrelevant. Whether I'm not saying it's going to happen, but that doesn't matter. You have to be buying the asset with the expectation that that will happen and that you can still survive it if it does, right? So you need to be underwriting a lot of economic vacancy into your deals to make sure that even in like your real honest to goodness worst case scenario, you can still make your debt service and you're not going to be looking at foreclosure, right? The other thing that I would be doing is writing a lot of reserves into the deal too, and making sure that it's still working even with all those reserves. Because again, if you get into a situation where you have a decline in occupancy, and on top of that, then you start running into some capital items, right? You get some unexpected capital stuff. You need a new roof. You have a water main break. I mean, just, stuff happens. These are apartments. Nature is happening to these buildings and people are happening to these buildings. And you have to be prepared for those things. So you've got to have a sizable reserve fund so that you have the cash to deal with these things that come up. So, and you have to work that into your underwriting too, to make sure you've got that cushion. Those are the things that I would be especially concerned about. And the other thing I'd be concerned about at this point in the market is, there's a couple more things. One is I'd be thinking about how much leverage you really want to go into these deals with. Because again, if you suffer a decline in occupancy, you're going to have trouble meeting your debt service if your debt service is too high. So you want to be conservative about that. And then the other thing is I've become concerned about the C-class renter, right? What they call the renter by necessity. Because, in the last recession, if you look at what happened with unemployment in the last recession, obviously it varied from market to market. So you really need to understand your market in terms of what potentially could happen with unemployment. But nationwide, unemployment peaked somewhere around 11% last time around. But if you break it down further into who lost their jobs, even with 11% unemployment nationally, like the peak for people with 4-year college degrees was something like 3.5%, right? So that means that for everybody else, it was a lot worse than 11% because people with college educations are like a third of the country, right? So if you're looking at C property as I was, getting into it at the bottom is great because the economy is taking you up. But when you're at the top and you're looking at like a C-class population, that population is the most vulnerable to a downturn. And those are the first people who are going to get laid off in a downturn. So again, if you're buying those kinds of property, first of all, I would go try to look for assets that have a little more stable population, perhaps, but you have more of a cushion if they do get laid off. So more of your B-class renters. But if you are looking at C-class, again, you really have to be thinking very strongly about how much economic vacancy you can take. And there's all these people out there who are spreading a lot of misinformation about what happens in a recession to multifamily, that it does well. It doesn't do well. It does better than a lot of other asset classes, but it doesn't do well. You're going to have occupancy dropping in a recession. And if the recession's bad, it'll drop more. And if it's locally bad, it'll drop a lot. You might also wind up with a situation where you've got a lot of tenants that you just don't want to evict, but they're not paying, right? Because at least they're in the apartments and the apartments aren't sort of rotting because they're vacant, right? So you've got people occupying them, which is better than having them completely vacant, but they may not be paying rent because they don't have any money to pay rent with, right? They've lost their jobs and they have no cushion. So you have to be prepared for this, right? You have to expect that this is going to happen, and don't believe the stories about, multifamily is going to skyrocket if there's a recession. It's not a recession-proof business. It's not a countercyclical business. This is a very much recession and economy-sensitive business, as evidenced by the fact that when I got started in the business, what people would say if you were if you're listening to a real estate guru, they'd say the most important thing when you're buying multifamily is jobs. They say jobs is number one, jobs is number two, jobs is number three. You don't hear people saying that much anymore because now everyone's worried about a recession. So the guru talk has become, oh, multifamily does great in recession, as if people don't lose jobs during recessions, but that's what's going to happen, especially at the lower end of things. Those are going to be the people who are going to lose their jobs. So be very careful if you're doing deals now, that you're taking all this into account. I don't ever like to tell people don't do deals. You may find a great deal out there. You may get lucky. You may find a seller who doesn't know what their property is worth. You may have a special situation. There's an estate sale or whatever. There are always these special situations that crop up. But what I want to warn people about is don't go into this with rose-colored glasses on, thinking that this is going to be easy, or that you've discovered some kind of like recession-proof asset class. Just isn't true. So go in with your eyes wide open and really make sure that you're fully taking account of the downside risks. And then if the deal still works, then yeah, go for it. I mean, if once you've taken all this into account, then go for it if you really feel like you've covered your downside risk. But you have to go in with your eyes open about this.
What about on the equity side now? So do you think that the investors are putting down cash to get into these deals? Do you think that they are prepared to take a lower return given where the economy is? Do you find that they are educated and they, as far as, there is a recession coming? Or do you have to kind of like, I don't know, reel them in a little bit? Those 18, 20, 30% returns of yesteryear are probably not going to happen in the next handful of years. Are you finding that true?
I'm not the best person to talk to about this because I'm not out there actively raising money right now. My understanding, though, from talking with other syndicator friends, is that equity investors have become a bit more realistic than they were. When I started in the business, everybody was looking for a 20 IRR. There were people who wouldn't even talk to you if you couldn't promise them a 20 IRR. And we were trying to get deals listed on crowdfunding sites and underwriting them conservatively, and that they were saying these deals aren't rich enough. But I know that's changed because I just even see what crowdfunding sites are posting as their big whoop IRR, and they're saying we're going to get a 13 IRR. A few years ago, they turned down 13 IRRs because they weren't good enough. So investor expectations have gotten more realistic. There's no yield out there, right? So people are kind of scrounging for whatever they can get. That being said, I still see, because my clients send me deals sometimes to look at as a second set of eyes, and I see some crazy stuff out there. I see some deals that are claiming to hit those really high IRRs, and I'm just very skeptical that they can.
Yeah.
And sometimes you see it in the underwriting, it's just not believable. Or more frequently, they're manipulating the exit cap rates to make the IRRs better. Whether they're intentionally doing that, maybe manipulation is a strong word, because maybe they believe that they're going to exit in 5 years at a 5.5 cap on a C property in suburban, somewhere. But maybe they really believe it, so they're not intentionally being misleading, but it certainly helps get the IRR up over that magical 20-point line when you can exit at a 5 cap.
Yeah. Yeah. I mean, I'm seeing the same sort of thing, not across the board with all syndicators, but there are a handful of them that I know that they're looking to buy in places like Dallas or Houston or Miami and expecting, minimum 20% IRR even today. And I just don't see it. I mean, maybe if you want to bank on an appreciation market like that, then go nuts. I just don't do that. I just can't. It's scary. To me, it's scary.
Yeah. I mean, I think the passive investors need to educate themselves really well these days on the syndicators that they're dealing with, but also not just on the syndicators they're dealing with, but they have to understand how to read these packages that they get from syndicators and understand what's going on there. Because I think when the correction happens, whenever it does happen, there are going to be a lot of very unhappy passive LPs out there who believed what they were told on rosy projections, and they didn't really have any way of digging into them and deciding for themselves whether they make sense or not. My clients have shown me stuff where there's reams and reams and reams of projections, but they never provide any of the background data. When I do a deal, I give my investors a big Dropbox deal room with all the information that I use to underwrite the deal, so they can re-underwrite it if they want to. I give them, live spreadsheets, that are not PDFs, they're Excel spreadsheets. They can go in and change the numbers themselves and see if what I'm saying makes sense. I really think all syndicators ought to be doing that, but I don't think a lot of them do. And I think, frankly, a lot of LPs wouldn't really know what to do either, even if they are presented with those kinds of materials. They don't know enough and they think real estate's safe. Real estate is a relatively safe asset, but when you're buying it at the height of the market, it's like everything else. The higher the market goes, the more risk is involved in your transaction. So as a passive LP, you've got to dig into the numbers and really understand how they work and how they can be manipulated. And don't just look at the bottom line of like how much profit you think you're going to get, because that's kind of like the least important number at this point.
Yeah, that sounds like another podcast right there.
Yeah.
All right. With everything you have going on right now, I guess to me, I would imagine that you're keeping maintaining that positive mindset is absolutely critical, right? I mean, I know you're refocusing your business right now on the educational model while you're waiting out the cycle. So how do you maintain success with business and family and everything else you have going on these days?
I'll answer the last part first. I mean, family, one of the just absolute best parts about this business is that I'm in complete control of my schedule. So I'm home whenever I want to be. I'm around my kids whenever I want to be. I go to all of their events. It's really unusual that I miss anything because I'm not at somebody else's beck and call the way that I used to be when I was practicing law. So that's the life balance that I find in this business is terrific. So if you can get to a point where you've got your basic needs taken care of, it's a really terrific business to be in. In terms of, mindset, I'll just tell you like what I struggle with myself now is I'm in the same situation as everybody else here, right? I would really like to be doing deals, and there are not a lot of deals out there. And at the same time, I see people doing deals all the time. So I've taken a position that the market is overpriced and that a correction is imminent, but I've taken that position for 3 years now and it hasn't happened, right? And I've come under a lot of criticism for it from people who have said, everything's fine, everything's fine, everything's fine. And look, you've been wrong for 3 years. So for me, the mindset struggle is maintaining my discipline through this point in the cycle, right? Where the deals are not meeting my criteria and I'm kind of stuck being on the sidelines. So I keep on returning to the wisdom of the investment sages, let's say, right? I'm a big fan of Warren Buffett and people like Sir John Templeton. And one of the things that there are a number of things that I return to that they say that kind of help me get through this particular point in time, which is one of them is just, you probably heard it a million times, but to be fearful when others are greedy and greedy when others are fearful. And we're living in that greedy moment right now. So whenever I'm feeling like, should I be doing deals? Should I be just trying to make something happen? Should I be, or even in the kind of a greedy moment, should I just be taking advantage of the fact that people literally want to throw money at me to go do deals? Should I just go make some fees? In a weaker moment, I just return to that saying like, this is the greedy time that I should be fearful in. And I remind myself of that. Then the other thing is that you get into, whether it's Warren Buffett or Benjamin Graham or one of my best friends is a really successful fund manager on Wall Street who's also, he's a value investor. And I've had many long conversations with him about sort of where we are. And at the end of the day, the way that you make money in an investment field is not losing money, right? You can have a very, very long string of success that can be wiped out in a moment if you have one really bad deal, right? So the key is, even more than thinking about sort of upside returns, is thinking about downside risk and how you protect yourself against downside risk, because not taking account of that downside risk can just wipe out all of the hard work that you've spent years and years and years creating. So again, I come back to that as like, this is a moment in which there's too much downside risk, right? It's all down. There's very little upside left anywhere. The risk is all to the downside. The risk of missing out on further upside is really minimal. So again, I come back to that, those sort of two things about the psychology of the market and then just not losing money to just give me additional patience to just wait this thing out. And in the meantime, I feel like this is a good moment to focus on education because, I got into this business right after the crash. And I just remember being so envious of the people who were like in it at the very bottom, like the people who just were buying assets on like for pennies on the dollar after the crash and were just reaping loads and loads of profits from these deals they picked up super cheap. And even in 2011, I was like, God, I wish I'd been involved 2 years before. And I sort of watched the whole thing happen from the sidelines. Like, I feel like now is the best time for people to educate themselves and get ready for this. So that's what I'm focused on. I'm focusing on like helping people get up to speed educationally, like get a really good education in this stuff now, get themselves ready, get their networks ready, like get their broker relationships ready, get their investor relationships ready, get themselves ready for this amazing opportunity that's coming. And even though we don't know exactly when it's coming, but we know it is coming. So, rather than be chasing what everybody else is doing, I think like get ahead of the pack and get ready for the next thing. So I'm sort of dedicated, like my mission at the moment is to try to help people get ready for that and also help them do it in a really like a high quality way, not like a rah, you're going to get rich, this is easy kind of way. But like, I want to make people really understand the investment process and think about it intelligently and think about the risks properly. And in that way, really be ready to make money when the opportunity is there.
Yes. I mean, yeah, certainly people can make a lot of money, but this is not an easy thing. It's simple. This business is not easy.
Exactly.
Well, let's get into the bullet round. All right. So you ready?
Sure.
All right. So if you can give your 20-year-old self word of advice, what would you tell them?
Nobody cares what you think. And I mean, nobody cares what you think and nobody's paying attention to what you're doing. So just go do what you want to do. Just go for it.
Nice.
Don't worry about what other people are thinking.
Excellent. 3 of your most influential books and why.
The Intelligent Investor by Benjamin Graham. It's the roadmap. Even though it's about equities, the thought process is the same about how to invest and build in a margin of safety. That's really, really influential. Another great book that I just think about all the time is Rational Exuberance by Robert Shiller, the Nobel Prize winning economist, about bubbles in assets. And a third is The War of Art by Stephen Pressfield, which is not a real estate book at all, but it's a book about how to just show up at work every day and just plug away, whether you want to or not, how you just keep on pushing against resistance and just push and push and push, even when you feel like you don't want to. It's a great book.
Yes. No, I love that book. Yeah, I have it too. Well, all right, guys. If you want to reach out to Jonathan or interested in his program, you can reach him at jonathan@multifamilylaunchpad.com. I hope you got a lot of great insight, understanding market cycles and how to succeed in downturns. It's going to be crucial to your success in this business. Absolutely. Thanks for your time, Jonathan, and greatly appreciate it.
Hey, thanks so much. I enjoyed myself.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.